This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. This year, the stock market has been focused on inflation. The massive stimulus spending to get the economy through the forced shutdowns of the COVID pandemic were successful. The stimulus has come with a cost, however. We're in the midst of a spending hangover, with the highest rate of inflation in more than 30 years. The tools to fight inflation are imprecise and painful. Too much money, too much demand, coupled with limited supply, has resulted in big price increases. To rein in inflation, we need demand to weaken. Although supply constraints began with supply disruptions, rising prices have spread throughout the economy, increasing the cost to produce goods. Meanwhile, with low unemployment, companies are fighting for workers, pushing wages, the single greatest expense for businesses, higher. It's a self-reinforcing cycle of higher costs and higher prices. So how do you reduce demand? Well, the cure is somewhat painful. Make capital more expensive. Reduce the easy access to cheap money. This is not a quick fix, however. High interest rates take time to have a broad impact. We're seeing some of the impact already, specifically in a sharp slowdown in housing. Most houses are purchased with debt, and the cost of a mortgage has more than doubled this year. 30-year mortgage rates, well, they're at 6.5% after hitting more than 7% in early November. While housing prices haven't declined significantly yet, the number of houses sold in the latter half of this year has declined significantly. The real estate market will weaken further in our view. To forecast where the U.S. economy and stocks will go from here, it's important to understand the impact of rising interest rates. So I'm a pilot. I've been flying small aircraft for more than 20 years. I earned my multi-engine instrument rating and have trained to fly aerobatically. I have more than 2,000 hours of flight experience. Bear with me, there's a point here. When I think of the Federal Reserve increasing interest rates to fight inflation, I can't help but think of a flight-related phenomena called pilot-induced oscillations. This is defined as sustained or uncontrollable oscillations resulting from efforts of the pilot to control the aircraft. This is a slight oversimplification, but basically it's a result of an overcorrection by the pilot resulting in a porpoising effect. There's a lag between the control input from the pilot and the resulting change in the aircraft attitude. For an inexperienced pilot, the increasing effect of overcorrections can cause a complete loss of control. The first time I flew a helicopter, I would have crashed due to my increasingly dire overcorrections if not for the flight instructor sitting next to me. The concept is not unique to aircraft in flight, but I thought it a useful way to highlight what's happening with interest rates and the Fed's fight with inflation and the trajectory of the economy next year. Most of us are familiar with the business cycle. Over the long term, the trend is for greater economic growth, measured by increases in gross domestic product. But the trend is never a straight line. It's generally 2 steps forward and 1 step back. The business cycle, in its simplest form, is distilled into phases of expansion, followed by a peak, then recession or even depression, a trough, recovery, and then a new expansion before the next peak and recession. Recessions are simply an unavoidable part of the cycle. Of course, some recessions are worse than others. Higher interest rates increase the cost of debt, causing companies and individuals to reduce spending. It's a rather imprecise way to reduce demand. I think of it as poisoning a person with chemotherapy to suppress the growth of cancer cells. We have to make you sick in order to make you better. The analogy to my pilot-induced oscillations is that the impact of rising interest rates to curtail demand takes time and has a significant lag. The economic data we're working from is in the past, and there isn't any certainty of how significant the impact of increased interest rates will be. Too much and you cause a significant recession. Too little and inflation persists or even increases, forcing more painful interest rate increases down the road. There is a reason why anyone that lived through the inflation of the late 1970s and early 1980s is so fearful of inflation. So the fear is that, like the inexperienced pilot, the Federal Reserve, working with limited data, will overcorrect and cause a painful recession. The best we can hope for is a proverbial soft landing. Weaken growth, weaken demand, increase unemployment, but not too much. Get consumers to dial back their spending and get companies to reduce investment. Together, this will be enough to get inflation back to the 2% target. We just don't want to kill the economy in the process. The bear case for stocks is that the Fed, with its limited toolkit, will overcorrect, raise rates higher than necessary, and push the economy into a significant recession. So far, the data is positive, however. Growth is certainly slowing, but the consumer is still spending. Earnings estimates for 2023 are being revised down. The earnings estimate for the combined companies in the S&P 500 have been reduced in 2023 to $220 per share from $250 forecast back in June. Earnings are now expected to decline this year from last. That's why stocks are down this year. After a huge acceleration in earnings growth in 2021, earnings in 2022 are now on pace for a slight decline. Although earnings are weaker, they're not down much. In 2008, earnings declined 40% from 2007. The 2% reduction so far this year from last is rather slight. Unemployment's still low. A softer landing is possible. That's why we've traded up from the lows. The S&P 500 is down 15% year to date, but it's up 14% from the low back in October. If earnings can hold up, the market will move higher from here. The problem is, while we see this as the more likely scenario, it's far from certain. The possibility that the Fed overcorrects in the fight against inflation is a concern. We expect this to continue to be a bumpy flight. Longer term, stocks historically perform very well coming out of a recession. Companies will have reduced headcount as they adjust their cost structure for the current weaker economy. As demand picks up, the cost savings result in better operating margins and greater profits, which will push stocks higher. The period immediately after a recession is typically one of rapid earnings growth resulting in very strong stock market returns. If you bought stocks at the market peak in 2007, just before the 38% decline in 2008, it took you 2 years to recover your losses. If you remained invested, your gain was more than 180%. If you panicked near the end of 2008, you locked in your losses, losing more than a third of your investment. There should be concern that the inexact tool for controlling inflation, namely increasing interest rates, could go too far and result in a slight recession. It's something we're watching closely. Every piece of data that shows inflation is moderating is met with a jump in stock prices. Maybe the Fed will be able to stop increasing interest rates sooner than later. If that's the case, that's a signal that an economic recovery is around the corner. But the lack of clarity produces significant volatility. For now, please remain seated with your seatbelt fastened. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching.